In a world where we are constantly told that markets are free, competition is natural, and governments ultimately decide the fate of societies, a darker interpretation has emerged among economists, analysts, and critics of modern capitalism. An interpretation that argues real power has quietly migrated away from parliaments, elections, and public debate and into silent financial structures where trillions of dollars are allocated with no direct democratic oversight. And at the center of this structure stands BlackRock, not as a shadowy villain from fiction, but as a measurable, documented concentration of financial influence unprecedented in modern history. Founded in 1988, BlackRock began as a relatively modest risk management and asset advisory firm, but within less than 4 decades, it expanded into the largest asset manager on Earth, overseeing more than $10 trillion in assets under management, a sum that rivals or exceeds the annual economic output of most countries. These assets are not owned by BlackRock, but the firm holds discretionary authority over how they are invested, where they flow, and which sectors receive capital or are starved of it. A reallocation of just 1% of these assets represents hundreds of billions of dollars, capable of moving markets, currencies, bond yields, and entire national economies. This is where the darker economic narrative begins. Critics argue that when such power is concentrated in a single institution, the question is no longer about intent or morality, but about structure. BlackRock manages money on behalf of pension funds that determine retirement security for millions, central banks that stabilize currencies, insurance companies that underwrite systemic risk, and sovereign institutions that represent entire nations, meaning that its internal risk assessments and allocation strategies ripple outward into real lives, shaping wages, housing affordability, employment stability, and long-term economic inequality. A core pillar of BlackRock's influence lies in its proprietary technology platform known as Aladdin, a risk management and analytics system that does not merely track portfolios, but models interconnections between asset classes, stress tests global markets, and simulates crisis scenarios. Aladdin is used not only by BlackRock itself, but by more than 200 major financial institutions worldwide, including some central banks and government-linked entities, giving the firm an unparalleled informational vantage point over global capital flows. Critics argue that this level of insight creates an asymmetry where knowledge itself becomes power, and where separating analysis from influence becomes nearly impossible. Through its dominance in index funds, BlackRock has become one of the largest institutional shareholders in thousands of publicly traded companies across nearly every major sector: technology, banking, energy, pharmaceuticals, defense, transportation, media, and consumer goods. In many cases, BlackRock ranks among the top 3 shareholders, granting it significant voting power in corporate governance, executive compensation decisions, mergers, acquisitions, and long-term strategic direction. Companies that appear to compete aggressively on the surface often share the same institutional owners behind the scenes, leading critics to describe a form of capitalism where competition exists in branding and marketing, but converges at the level of ownership. This phenomenon is especially visible in the exchange-traded fund market, where BlackRock dominates through its iShares brand, controlling over $3 trillion in ETF assets globally. These funds track major indices and drive automated capital flows, meaning that billions of dollars move in and out of stocks and bonds based on index inclusion rather than human judgment, social need, or productive value. Critics argue that this automation amplifies volatility and detaches financial markets from the lived realities of workers and consumers. During periods of crisis, BlackRock's role becomes even more controversial. During the 2008 global financial collapse, and again during the COVID-era market shock, governments and central banks turned to BlackRock for advisory roles in designing and executing asset purchase programs and stabilization mechanisms. This placed a private, profit-driven firm at the heart of public rescue efforts, a situation critics view as a closed financial loop, where the same institutions embedded in the system are tasked with managing its failures, raising concerns about conflicts of interest and systemic accountability.
The housing market provides a tangible example of how these abstract flows translate into everyday consequences. In the United States and other developed economies, institutional investors, including funds associated with BlackRock, significantly increased their presence in residential real estate. Homes increasingly became long-term investment assets rather than primary residences, contributing to rising prices, reduced affordability, and declining rates of homeownership. While BlackRock itself often emphasizes indirect exposure rather than direct ownership, critics argue that the broader trend of financializing housing cannot be separated from the scale and incentives of institutional capital. Financially, BlackRock generates tens of billions of dollars in annual revenue, primarily through management fees calculated as a percentage of assets under management. This business model ties its growth directly to the expansion of global financial assets, not necessarily to improvements in productivity, wages, or living standards. The larger the system grows, the more the firm earns, reinforcing a feedback loop where stability is defined in market terms rather than social outcomes. The darker economic interpretation does not require BlackRock to be consciously malicious. Rather, it suggests that the modern financial system has produced institutions so large and interconnected that their influence becomes automatic. Power no longer needs intention when it is embedded in structure, algorithms, and market mechanics. Critics argue that this is how economic control evolves in the 21st century, not through overt domination, but through normalization. What unsettles many observers is not that BlackRock exists, but that it has become indispensable. Pensions depend on it, markets rely on its liquidity, governments consult its expertise, and corporations respond to its voting power. Yet ordinary citizens have no direct mechanism to question or influence its decisions. Economic democracy remains largely symbolic, while financial governance operates beyond public visibility. The conspiracy narrative, as framed by its critics, is not about secret cabals, but about silence, about decisions that affect millions being made far from public scrutiny.
About a system that rewards concentration until it becomes invisible, BlackRock does not need to rule the world, it only needs to be woven into everything the world depends on. The final question, then, is not whether BlackRock controls the global economy, but how the global economy became structured in such a way that a single financial institution could accumulate this level of influence without meaningful democratic oversight, and whether a system built on such concentration can remain stable, equitable, or accountable in the long run.